Welcome to the deep dive. Today we are buckling up for an in-depth look at a true defense titan, Lockheed Martin, ticker symbol LMT. We are tackling a really fundamental question, I think, about the future of these kinds of companies. Can a 20th century hardware giant successfully pivot, transition into a 21st century digital systems integrator, or is it just, well, too big to change? Our mission today is to distill the comprehensive analysis of LMT. We've got a stack of research here, current as of October 6, 2025, and the stock price sitting right at $504.49.
And here's the thing, the central contradiction that makes this so tricky right now. On one side, you've got Lockheed Martin with arguably the most durable competitive moat in the world. Think multi-decade contracts, a record-breaking $166 billion backlog, just huge stability. But on the other hand, management is facing these multi-billion-dollar execution failures on critical programs too, and their profit margins, they're shrinking. Despite all this internal strain, the stock is still demanding a historically high premium from the market. Our analysis found the current stock price is trading, well, squarely in the middle of our estimated intrinsic value range. So for value investors, it's a really tough spot.
Exactly. Yeah, it's this messy conflict, isn't it? And that's why we made LMT a priority deep dive here at Stock Analytics AI. It's part of our goal to give you comprehensive, nuanced coverage of every S&P 500 stock. Okay, let's kick off with part one in chapter one, business understanding. Let's unpack the business model itself. Lockheed Martin is, well, the textbook definition of a prime contractor, right?
Right. Absolutely. Their main customer, overwhelmingly, is the U.S. government.
Right.
It accounted for, what, 71% of their sales just back in 2021?
Yeah.
A massive chunk.
31%. Wow. And they build and sustain some of the world's most complex military hardware.
Right. And the durability of their success, it really lies in what we often call the razor and blades competitive moat.
Explain that.
Sure. So the initial sale, that's the Razor, think an F-35 fighter jet, it's a huge capital spend for the customer. But that first transaction, it locks in decades of follow-on revenue, higher margin revenue too, from required maintenance, sustainment, critical software upgrades. Those are the blades.
Okay. So once a customer buys the jet.
Yeah, once they're flying that jet, switching to a competitor is, practically impossible. The logistical cost, the financial cost,
Yeah.
it's just prohibitive.
The scale is just astronomical. If we look at their 2023 revenue breakdown, aeronautics is the biggest segment, 41%.
41%, yeah. That's home to the legendary Skunk Works, of course, but more importantly for the bottom line, the F-35 Lightning II.
And the F-35 itself is huge for them.
Huge doesn't quite cover it. Here's the key number. The F-35 alone accounts for a full 26% of LMT's total consolidated net sales.
Wow, over a quarter of the entire company from one program.
Exactly. Now that 26% figure, it's fantastic for stability, sure, but it's also the definition of concentration risk, isn't it? Meaning any major execution problem, any political issue, any budget cut specifically hitting the F-35 program, well, it instantly risks crippling a quarter of the entire company's sales pipeline. It's a vulnerability.
Right. Okay, beyond aeronautics, we've got rotary and mission systems, RMS. That brings in about 24%.
Yeah, 24%. That covers iconic things like the Black Hawk helicopter and the high-tech Aegis combat system for naval defense.
And then missiles and fire control, MFC at 17%.
Yeah.
That sounds critical right now.
Extremely critical. That's where you find defensive systems like PAC-3 and TAE, and also key offensive platforms like HIMARS GMLRS and the Javelin missile, stuff you hear about all the time.
So just to give a sense of their stability, they're the world's largest defense contractor.
By far. And as of Q2 2025, their order backlog hit a record $166.5 billion.
$166.5 billion.
Yeah. And what's really crucial here is that this backlog is actually growing faster than they're recognizing revenue. That gives them truly exceptional multi-year visibility into future sales. It's baked in.
And competition. It's basically just a few other giants.
Exactly. It's an oligopoly. You've got Boeing, RTX, Northrop Grumman. That's pretty much the club. And the barriers to entry are, well, almost insurmountable. You're talking tens of billions in capital, specialized intellectual property. Plus, you have to comply with layers and layers of regulation like ITAR and CMMC.
Which controls sensitive defense data.
Right. And that regulatory complexity itself, it acts as an almost impenetrable moat. You can't just decide to start building fighter jets tomorrow.
Okay, moving on to chapter 2. Management evaluation. All these huge contracts, these massive execution risks, they ultimately land at the top, right?
Yeah.
Which brings us to the CEO, James D. Teichlet. He's got a bit of a non-traditional background for defense, doesn't he?
He really does. I mean,
Yeah.
Air Force pilot, yes, that fits. But crucially, he was the former CEO of American Tower.
Right, the cell tower, right?
Yeah, where he oversaw Just massive market cap growth, something like $2 billion to over $100 billion. He's first and foremost a strategy and scale guy.
And this leads to what you call the leadership paradox.
Exactly. This is where it gets really interesting. Tyklet has, I think, correctly championed this forward-looking 21st century security strategy, integrating things like 5G, AI into defense systems. It's a necessary strategic move. He's looking ahead 10, 20 years.
Yeah.
Strategically spot on, but operationally, the execution has been, frankly, devastating. Running a global cell tower REIT is fundamentally about leveraging static, repeatable assets.
Okay.
Running Lockheed Martin requires flawless execution across incredibly complex global supply chains. Hundreds of thousands of specialized engineers. It's a completely different operational beast. And those multi-billion-dollar losses we're seeing suggest that that operational transition, or maybe the oversight, is failing.
Let's drill into those losses specifically. We saw huge cost overruns recently.
Staggering, yeah. In Q2 2025 alone, the company booked $1.6 billion in losses, primarily tied to just one single classified fixed-price aeronautics program.
$1.6 billion on one program.
That's right. And this raises a really important question for you, the investor, to think about. Is this ambitious 21st century security strategy even achievable if the core hardware business can't stop bleeding cash on current multi-billion-dollar contracts? I mean, the strategy relies on a stable, profitable hardware base, doesn't it? And that base looks well strained right now.
And this tension seems amplified by their capital allocation strategy. They're being very aggressive returning capital to shareholders, even with these internal execution problems.
They are. They invested, what, $3.4 billion in R&D and CapEx in 2022, which is good. You need that. But they're also really prioritizing shareholder returns.
They have that long dividend streak.
23 consecutive years of dividend increases. They clearly want to protect that. They're projecting $13.20 per share in dividends for 2025. Plus, they have a massive $10 billion still authorized for share buybacks.
Okay, so spending on R&D, but also heavily on dividends and buybacks.
Which brings us to a major financial red flag, in my view. The return on invested capital, or ROIC, is crashing. ROIC is maybe the single best metric for evaluating how effectively management uses capital, right?
Yeah.
How much profit they generate from the money put into the business.
And what's happening there?
Well, it was at an incredible 40.88% back in 2019. But the latest trailing 12 months figure, it's plummeted to just 19.22%.
Wow, that's more than halved.
Exactly. That steep decline strongly suggests the billions they are investing right now are becoming rapidly less profitable. And that's a direct consequence, really, of those fixed-price program losses and the cost overruns. It points to an efficiency problem.
All right, let's pivot now to Chapter 3, Financial Analysis. Looking at the raw numbers on the financial statements, revenue growth seems pretty modest. A 5-year compound annual growth rate of 3.5%.
Yeah, which is kind of expected for a stable, mature defense giant like this. It's not a high-growth tech stock.
And earnings used to be very consistent, right? They peaked at $27.55 EPS in 2023.
Highly consistent historically. But again, those execution failures we talked about, they broke that consistency. 2024 EPS dropped sharply down to $22.31 because of those program losses.
Okay, so revenue steady-ish, but earnings took a hit.
But the real key bearish argument, I think, centers on the margin compression story. This is a sustained and frankly concerning trend.
Why are margins shrinking?
Two big factors, mainly. 2024, and the latest TTM figure is even lower at 8.3%.
And the cost.
Massive inflation driving up raw material costs. So one. And two, those major cost overruns on their fixed price development contracts. They sign a contract assuming costs will be X, but because of inflation and maybe poor management, the actual cost ends up being X plus a lot. And on a fixed price deal, they eat that difference.
Right, that directly hits the profit. Okay, what about the balance sheet? How does the leverage look?
Calculated, maybe, but definitely strained. Their debt-to-equity ratio is very high at 4.06.
4.06, what does that mean practically?
It means the company relies 4 times more heavily on debt financing than on shareholder equity to fund its assets. It's significant leverage. And their current ratio, which measures their ability to cover short-term bills, is 0.98, just below that crucial 1.0 mark.
So less than $1 in current assets for every dollar in current liabilities.
Exactly. It signals a heavy reliance on long-term debt and maybe limited operational flexibility if things go wrong in the short term. They don't have a huge cushion.
And this brings us back, again, to that valuation contradiction you mentioned at the start.
Yes, it's fascinating. Despite the drop in earnings consistency, the falling margins, the high debt, LMT's trailing 12 months price-to-earnings ratio sits at 28.25.
Which is high compared to...
Well, compared to its own history, for one, their 10-year average PE is closer to 20, and peers like Northrop Grumman and General Dynamics are trading around 22 times earnings.
So you, the investor, are currently paying $28,000 for every dollar of their annual earnings. Why?
That's a great question. It's likely fueled by geopolitical instability, driving defense spending higher, and maybe the sheer certainty investors feel about that massive backlog and that reliable dividend streak. People pay a premium for perceived safety, even if the underlying financials show some cracks.
Okay, let's move into part 2 now, starting with chapter 4, market sentiment. How does Wall Street actually view this highly leveraged, premium-priced, but deeply entrenched defense company?
Well, the overall consensus among analysts is basically a hold rating. Not a strong buy, not a sell, just hold.
But you said there's a kicker?
Yeah, the interesting part is the average 12-month price target. It's clustered somewhere between $473 and $488.
Which is below where the stock is trading now, $504.49.
Exactly. The analysts, on average, think the stock is worth less than its current price over the next year. That's telling.
So we're seeing a real split here.
A clear divergence, yeah, between the technical picture and the fundamental picture. Fundamentally, analysts are nervous. They see those $1.6 billion program charges. They see the margin risk, the valuation. But technically, the stock chart looks strong. It's showing momentum, trading comfortably above both its 50-day and 200-day moving averages.
And what's driving that technical strength, if not fundamentals?
It seems driven less by LMT's own operational excellence right now and more by those external forces we mentioned, rising geopolitical risk-making, defense attractive, and maybe a flight to quality, investors seeking out that predictable dividend.
And that technical support seems pretty solid. No one's betting heavily against it.
Apparently not. There's very little conviction among bearish traders that a major correction is coming soon. Short interest is extremely low, hovering down around 1.05% to 1.43% of the float. Not many people are shorting the stock.
Okay, let's look at who actually owns the stock in Chapter 5. Ownership structure.
Right. Lockheed Martin is overwhelmingly owned by institutions. We're talking about 74% of its shares. And the top holders are the usual giants, State Street, Vanguard, BlackRock.
And the implication of that is?
It's crucial for you to understand this. A huge chunk of that institutional ownership, it's passive. Index funds, ETFs.
Right, funds that just have to own it because it's in the S&P 500.
Exactly. And passive owners rarely put pressure on management to fix things like execution issues. They just hold the stock. So this structure effectively kind of insulates the leadership from activist pressure, doesn't it? It allows internal flaws, like those operational failures, to potentially persist without an immediate penalty from major shareholders.
Interesting. And what about the insiders, the people running the company?
Well, the insider signals reinforce that maybe lack of urgency or at least lack of bullishness. Insider ownership is minuscule, less than 0.1%. Tiny. And crucially, look at the trading activity. In the last 12 months, there have been 0 open market purchases by insiders. None.
0 buys. What about sales?
Contrast that with numerous high-value sales, including, for example, a $2.1 million sale by the president of the Rotary and Mission Systems Division, the one overseeing Black Hawk and Aegis.
So insiders aren't buying, and some are selling significantly.
Right. It's a fair question for you to ask. If the people running the business are selling, why should you be buying? It's not a confidence-inspiring signal.
All right, let's pull the threads together in Chapter 6. Risk assessment. Let's summarize the key strength first. What forms that defensive moat?
Okay, strengths. LMT still possesses world-leading R&D, especially through Skunk Works. They have the diverse and deeply entrenched F-35 portfolio, which, despite the concentration risk, is a massive asset. And of course, the anchor. That stable, huge, $166 billion backlog, that guarantees revenue.
Okay. But the weaknesses are pretty stark, too.
There's persistent, yes.
Yeah.
We have that high dependency on the U.S. government, always a risk if budgets shift.
Yeah.
And then that central defining weakness we keep coming back to, the multi-billion-dollar execution failures.
Compounded by
The high financial leverage, that 4.06 debt-to-equity ratio we discussed. It reduces their buffer if things go wrong.
And then there are external threats that could make things worse.
Definitely. And these external threats dangerously amplify those internal flaws. Inflation is the clearest one. It directly squeezes those already compressed margins, especially on the fixed-price contracts.
Makes sense. What else?
We also have to consider the geopolitical and specifically the tariff threat. The U.S. imposed tariffs in 2025 ranging from 10% to 25% on key imported materials like Defense electronics, composites.
Things LMT needs to build its products.
Exactly. These tariffs will significantly increase LMT's production costs. So this external pressure directly magnifies their internal weakness in controlling costs on that fixed price work. It's a double whammy.
Okay, threats noted, but there must be opportunities too.
Oh, absolutely. The opportunities are very real. International expansion is still a huge lever. As allies around the world increase their defense budgets, that's a tailwind. And there's significant growth potential in modernization and sustainment work, the blades part of the model.
Yeah.
That tends to be far higher margin work than the initial big hardware sales. So growing that side is key.
Okay, let's wrap this up in Chapter 7. Conclusion. Let's try to synthesize this complex picture. Can you summarize the bull case again?
Sure. The bull case is fundamentally about certainty, I think. You're buying that massive, durable, competitive moat. You're buying the non-cyclical stability provided by the $166 billion backlog.
Yeah.
And you're buying that 23-year commitment to dividend growth, which many investors prize highly. It's about predictability.
Okay, predictability. And the bear case.
The bear case demands your attention, frankly. You have to contend with serious operational flaws leading to those multi-billion-dollar losses. You have a stock trading at a significant historical premium at PE of 28.25. You have a strained financial structure, the 4.06 DE ratio, and that really concerning trend of falling profit margins. It's about execution risk and valuation.
Right. And when we put all this conflict through our educational discounted cash flow analysis, where did we land on intrinsic value?
Our DCF model spat out an intrinsic value range of $477 to $575 per share.
Okay, $470 to $549. Right in the middle, smack dab in the middle of the range.
So quantitatively, the stock looks fairly valued.
Pretty much, yeah. Quantitatively fairly valued today, which means the decision for you, the investor, hinges entirely on a qualitative judgment, really. It boils down to this. Do you believe management can successfully execute its forward-looking 21st century security strategy and, crucially at the same time, resolve the internal cost control and execution failures that are currently hammering their margins? So the certainty of the moat versus the uncertainty of management's execution.
That's the core conflict right there.
Okay. That leaves us with a final provocative thought for you, our listener. Given the incredible stability provided by that $166 billion backlog, that's basically guaranteed sales for years. How much of a premium are you truly willing to pay for that certainty when the certainty itself is being actively undermined by these consistent multi-billion-dollar operational missteps? Something to think about. That wraps up our deep dive into LMT. If you found this analysis helpful, please do like and subscribe to the Stock Analytics AI channel. Remember, our $4.90 non-month members get priority deep dives on all S&P 500 stocks, plus priority access to all new reports over the coming months. We are covering all of the S&P 500 stocks, and members get exclusive priority access. And if you just want a one-off deep dive on a specific ticker, you can always drop us a super thanks.
And just a final important reminder. This comprehensive analysis was generated by an AI system using public data. It's purely for educational purposes, okay? Should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.